Hello, ladies and gentlemen. This is Christopher Aaron. It is February 14th, 2018. Thank you for tuning in. This is a very serious video. The Fed has no idea what it is doing. Neither does any central bank, for that matter. They are flying by the seat of their pants. They're making up monetary policy as they go along. We will look at examples throughout history when the Fed has lost control of the markets, which is what is about to happen over the next 12 to 36 months, as I predict. So this is a very serious video, but it's not too serious that I can't wish you a happy Valentine's Day. Happy Valentine's Day, and please enjoy your day. And let's look at it. What has been going on recently in the markets? It's been quite a volatile several weeks since I have last spoken with you. The big item on the agenda is to focus on the bond market and how the bond market has been diverging from gold here just over the last week or so. I made a video about the bond market a few weeks ago, but it wasn't that popular because it doesn't sound that interesting. But when you realize that this is going to be the main driver for the precious metals market, when these things start to move in opposite directions for real, for good, then you will start paying attention to the bond market a lot more closely. And so let's bring up that bond chart, the price of the U.S. 30-year bond. This is the longest bond that is sold by the U.S. government. This basically allows the government to fund most of the spending programs, especially relating to unsustainable wars and bailouts and whatnot. And what we're seeing is that the price of this bond is beginning to form something of a mini crash here. And the important thing to note is that this bond has been rising in price. In other words, interest rates have been falling this whole time for 36 years. Can we imagine that when this lower trend line is broken, which I predict will happen sometime in early 2019, that we will have a solid technical signal that bonds have entered a bear market? This may be an equal length bear market in time as was the bull market, 36 years. And there are a number of people who will tell you that this could not happen because the Fed would intervene. And the Fed is all powerful. And who is this Fed anyway? This bunch of people, these bankers slash politicians. If you want to ask me, the Fed is actually the biggest bubble in the world. It's not real estate, it's not stock market prices, it's not cryptocurrencies. The Fed itself is the biggest bubble in the world right now. There's this belief that the Fed has control of the system, bar none. I think this is going to be proven false fairly shortly. Let's look at another time in history that this was considered to be absolute gospel, considered to be truth, that the Fed controlled a certain market. We're talking now about bonds, but let's go back in history. Let's look at the Fed in control of the gold market. I want to rewind a period of history that is not studied very often, but let's look at this. We're talking about the price of gold from the 1950s through the peak in 1980. A lot of people pay attention to the peak, but they don't pay attention to what happened in the years leading up to that major rise in gold. So the Fed had an official price for gold at that time. The official price was $35 per troy ounce. Troy ounce is slightly more than 32 grams. The official price was set at $35 per ounce after the devaluation of the dollar in 1933. So this had held for almost 40 years. 40 years where the Fed controlled the price of gold. We want to talk about manipulation. We'll talk about that coming up here shortly. Pay attention to this. However, people don't study this time period right here in the late 60s. The red shaded box. Let's zoom this in. Keep in mind, the Federal Reserve said that the price of gold was $35 per ounce, and they held it at $35 per ounce. The U.S. government backed its weight behind that decision. Settlements for debt as paid in gold was set at $35 per ounce. And what happened? Let's zoom this in. That little red shaded box, look at this. The price of gold in the late 60s broke the Fed standard. It broke the Fed standard at $35 an ounce and began to rise. Think about what is happening here. The official price of gold was still $35 an ounce, but the market overwhelmed the price of gold. The market said, "We don't believe you, Fed. We don't believe that you know what you're talking about. We actually think the price of gold is higher." And the market forced this higher. The Fed forced it back lower a couple years later, but we know what the result was. Gold moved on from $35 up to $850 an ounce, a gain of over 2,000% over the following 10 years. The point is, the Fed does not have absolute control over anything that they claim to have control over. Let us just keep this in mind as we go forward. So let's take a look at the price of gold. What happened today? This was a huge day, a totally massive day. And I'm not going to bring up the regular charts. I usually rely on Kitco for those charts, but I wanted to bring up this chart because it shows intraday. We're looking at a 1-minute bar chart here of the price of gold from today only. So, at first what you can notice is a very nice rise up through 1350. We'll put this into perspective in just a moment. But the bigger thing that I want to draw to your attention is this little thing right here. This was a 1 minute. Look at this. This is a 1 minute flush of the price of gold from 1,331 down to 1,318. Let's call that a $13 or a 1%. Imagine this. The international 5,000-year store of wealth upon which all monetary systems have been based throughout the history of mankind fell by 1% in 1 minute this morning. So, yes, I believe there's manipulation. It's not that I believe it. We can actually see it happening here in real time. But there's more to this, which is that this is what they call a flush. This was a stop flush. So you have to be very careful. I'm speaking especially to short-term traders at this point. We're talking about, we will look at the hour chart in a moment, but if you had predicted this rise here, and there were some signals showing that gold was about to break out, but if you had your stops in here, the banks just flushed you right before, boom, they springboarded it higher. So I absolutely believe there is manipulation in this market, but what the charts can show us is where the manipulation occurs. Keep that in mind. We were just looking at this one day right there. Let's get rid of that. And we're now looking at the 1 hour bar line of gold from the recent peak. Now, if you're more of a short or medium term trader, I would say to pay attention. These 1 hour, I'm looking at 1 hour candlesticks right now. These 1 hour candlesticks tend to be, when you see a break of a clear channel on the 1 hour bars, you see the break right here. This tends to be a very good signal for an intermediate term trend change. And by intermediate term, I generally mean anywhere from a few weeks to a few months. So we just had this 3-week downtrend broken today. Look at the flush of the stops. My heart is with you on this Valentine's Day. If you got stopped out, if you're a futures trader, right here, because these banks had it in for you. So just remember that. I do know that there's manipulation in this market, but I also know that we can see it on the charts, and that's why the charts are valuable to study. Let's zoom this out. Oh, sorry. What was the cause, quote unquote, if we want to assign a cause? Of course, there are thousands of causes. There are infinite number of causes because each trader is thinking a different thing. But what is the market? What is the financial press labeling as the cause today? We're talking about CPI surging 0.5% in January alone. Look at this biggest CPI rise. This is consumer price inflation, so 0.5% in 1 month. And they're saying, okay, we're not going to annualize it at that rate. We're going to say that the annualized rate is 2.1%. These numbers are fairly low as far as an annualized rate, but even if we want to take the financial press and the Fed at their word and say it's a 2.1% annualized inflation rate, mind you, compound this over several years, and the result, the answer as to how quick does the currency lose its value, at a 2.1% inflation rate, the currency loses half of its value in 28 years. One of the basic definitions of money is that money should act as a store of value. And under our system, the currency, the money, is losing half of its value every 28 years. So I'm saying it's failing at a basic function of its definition right in front of our eyes. Keep in mind, these are the official statistics. The actual rate is probably significantly higher than this, but let's round it down to the official statistics. Get rid of that so we can see the result on the market after that flush if you were able to hold on, which is why, by the way, I do not recommend trading with your entire portfolio. Even when we do a trade here, whether it's a trade in the mining equities or a trade in the metals itself, we only trade a small amount and we hold physical bullion as the core of the portfolio. It's exactly for this reason. It's so the central banks cannot flush us out of our position. Let's zoom this out and look at the form of the charts that we usually look at here. This allows us to bring up the key. I know there's a lot going on here, but this is all having a rhyme and a reason to it. So take a moment, study this chart. We were anticipating this drawdown here. I spoke about this 2 weeks ago. That's the drawdown that we said. My initial expectation was that the price of gold was going to fall lower into the resistance zone. However, I maintained an overall bullish stance. As per my overall portfolio, we took some minor short positions that we had to close today at a loss, which is fine because that shows me that this sector is getting ready to move higher. Now, this happened a lot quicker than I thought it would. I will tell the truth. A lot quicker. That what this is telling me is that we're not going to get that drawn out serious decline to retest, especially this 1236 level. We're not going to get that. So if you've been waiting on the sidelines in the gold market, your opportunity is now, and it's over the next several weeks, perhaps 1 or 2 months. I could see us still having, after a bit of a follow through, still a bit of a minor retracement back into the mid-level of this consolidation here. But let's not mince words. This market is getting ready to take off. It looks like it's going to happen sooner than the third quarter, which was my original expectation. Bit of shameless self-promotion today. This was our portfolio. I'm not going to name the names because I have to save that for those who pay for the research. And also it would be really irresponsible for me to just list the gold miners that we are invested in here, because a whole part of this is, what if something goes wrong? We have this happen periodically. A miner will have a problem. The mine will experience some low grades, or there'll be an avalanche within the mine. We have to sell one of the miners. So I don't just publish a name of the stocks that we're investing in here, because I truly do believe that if you want to invest in the miners, you have to follow this on a week in and week out basis. And most people don't want to put the research in to actually do that. That's why I publish the research here for what I believe is a fee that is affordable by most people who are actually looking to make serious investments into the sector. That said, we had some pretty good gains today. We're back to about even in the portfolio because most of these miners have been underwater for the last several months. Some pretty good gains today, but let's put this into perspective. If you're considering the gold mining sector, please remember this. They will underperform during certain periods of time, and then they will overperform. The miners have been underperforming for the last year, almost year and a half. The miners, their profits are leveraged to the prices of the metals themselves. And what I don't want to see, I really don't want to see a whole lot of people chasing this market 6 to 12 months from now. That's what happened here in the beginning of 2016. Very few people were prepared for this. And so a lot of people started chasing the gold miners higher in May, June, and July. And it's very tough to say when these significant peaks are going to form. But people were chasing it higher, and that led to a lot of pain over the short run. Now, we have a lot higher targets for the price of gold coming up over the next 12 to 18 months. It's not going to move in a straight line. There is going to be a period of time where we look to take profits, probably about 12 months from now. But I just wanted to show, if you're interested in this, understand this, you haven't missed the move yet. Look at where the gold miners, the price of the gold miners, the GDX Fund here, have lined up with the price of gold for where it was over the last 3 times. This 21 level on the GDX was matching up with the low 1200s here for gold. And then after this surge, after the break of the long-term downtrend, we saw the 21 level match up with 1236 gold. And then we saw it match up here recently with 1305 gold. So a lot of people are concerned that they've missed the move, and what I'm saying is this looks to be in a highest probability assessment. We can never predict the future, but a highest probability assessment looks to be like this is one of those rare times. We showed examples in the past, such as 2003 through 2005, that the miners lagged the price of gold. They just underperformed for about a year, 18 months, and then boom, they shot higher. And the moves higher, you can see this, they tend to be about 6 months, and they take off like a rocket. They don't leave a lot of wiggle room for people to get involved if they're waiting on the sidelines. So you kind of have to get in during the consolidation, take your chops, the ups and downs, and get ready for the next move. That's what appears to be setting up right now. And just for perspective, if the GDX gets back to its previous peak here, only that, which the price of gold is already approaching, this will be close to a 50% gain in all the miners, all things considered. And then I think they're going higher after that later this year into 2019. Big picture macro, is this sector overdone? Well, we are looking at the price of the gold miners, the XAU index, which dates back to 1984, relative to the entire U.S. stock market as represented by the S&P 500. And we're saying that this is still, all things considered here, the lowest valuation that has ever been seen. Ever. For the history of the gold and silver mining sector relative to the rest of the economy. We can see they can go down. Look, these miners can fall 30 or 40% within a couple of months. So this is not a place to store your rent payment for the next month, because if it goes down, then you're out of luck. But from a risk to reward basis, when there's a chart like this that cannot go to zero, but it can go 3,000% higher to get back to a previous established peak level, there's certainly something that must be considered here by a rational investor. Big picture, once again, this institution that we know as the Federal Reserve is not all-powerful. There have been two central banks in the history of the United States. Before this one, they have failed. And the third one is edging ever closer to a precipice of losing control of the most important part of the economy that actually matters, which is the bond market. Of course, the currency is going to be a component of the bond market. So never let anyone tell you that this institution has everything under control and will simply force yields back down. We've seen times where they have tried to force things back down, such as the price of gold in 1968, and they have failed. There's another big failure coming up here over the next couple of years into the next decade. This is going to be an absolutely fascinating time to be alive. I truly am glad to be here, to be a participant in these markets, and I'm glad to have you here as well, especially on this Valentine's Day. Just to let you know, I do produce a premium research service that goes out weekly. We cover not only the prices of the physical metals, gold and silver, in videos like this that have a lot more depth even. We also cover the GDX, the individual miners that we are buying and selling here, as well as all the research to back that up. As I said, I feel it would be irresponsible to simply go out and buy a bunch of miners and not follow their fundamental developments throughout time. How else do you know what's happening with the company? Things do go wrong from time to time, and we have to make adjustments. You can find more about that on the website. If you're new to the precious metals, or you are thinking about a change in your strategy, I do individual consultations on a one-on-one basis. And I know if you're new to the precious metals, all these charts and all this sort of background information can seem a little bit overwhelming. I completely understand it. Everyone has begun at some point with their studies of these markets. Just letting you know that I work with individuals, whether you are a new stacker and you want some sort of recommendations, what would I do if I was in your situation? And I also work with those that are looking to take it up to the next level, traders, and those looking to fine-tune their mining portfolios before the next launch, which looks like it is right on the steps in front of us. Thank you very much, and I will see you this time next week.